Welcome back to a new video for dividend investors. Would you like to invest in dividend ETFs but you are not sure if it's the right choice as a dividend growth investor? I hear you. In this video I will show you some of the pitfalls and downsides of investing in dividend ETFs when following a dividend growth investment strategy. But just to be sure, this video will not tell you that dividend ETFs are a bad choice to invest in. To the contrary, there are actually quite some good dividend ETFs out there. And I will prove that by also showing you 3 top-notch dividend ETFs which deserve a place in a typical dividend growth investor's portfolio. It's just important to know that not all dividend ETFs are the same and some of them are actually very misleading. If you're new to this channel, just know that it's my goal to make dividend investing easier for all of us in the community. So stay tuned, have your coffee or tea, and let's get started. As a dividend investor, it's really important to remember and to keep really focused on what investment strategy you are following. Today, I'm looking at it from a point of view of a dividend growth investor. So let's recap what a dividend growth investment strategy is about. Dividend growth investors invest in dividend paying stocks, but what's really important here, that grow their dividends every year, preferably above the rate of inflation. Why is this important? Because as a dividend growth investor, your ultimate goal is probably to reach financial independence and early retirement at a certain age. For this, you will need to start to replace your active income, your income from work and salary, with passive income, for instance dividends. Because at a certain moment, what you want to achieve here is really that the dividend income starts to cover your daily expenses or your monthly expenses. How you do this is by investing in dividend-paying stocks or dividend ETFs on a monthly basis and reinvest the dividends that you're getting while you're in the accumulation phase. Once you hit financial independence, you will probably stop the reinvesting and let the money ride and live from the dividend income going forward. But why would you choose dividend ETFs over the individual stock picking? Well, here's a simple overview that I've also placed on my website. I will share the link in the description of this video, because a dividend ETF really saves you time. The thing is, if you're investing in individual stocks, you need to understand the companies that you're investing in. It has some advantages. As an example, you might have a better chance on a higher yield on cost. At the same time, there's also more risk involved because just simply a dividend ETF which has 40 to 100 stocks just gives you better diversification. So today we're talking really from a dividend ETF point of view. I'm actually looking into starting more and more to invest in dividend ETFs, not for my core portfolio, but rather for my wife. My wife is also earning money from her salary. We're not doing a lot with that cash at the moment. And I think it's better just to invest it in dividend paying ETFs that are growing their dividends over time. But it is important to understand that there are some pitfalls that we want to avoid, because not every dividend ETF is the same. So let's have a look into the typical pitfalls of dividend ETFs first. As an example, there are many dividend ETFs out there that have just no or very poor dividend growth. I will show you one of them soon. But also, they might have a very low starting yield. You need to know that if you want to reach financial independence at a certain moment, you might need an average yield on cost plus a particular annual dividend growth. It is just so much harder if your dividend ETF gives you like 1% and you need to grow by 10% per year before you reach the same amount of yield on cost as when you start with 3%, maybe with 6 or 7% per year. You need to take this into consideration. And at the same time, we're now at a really high multiple in the stock market, which all makes it much more harder to find the right dividend ETF. At the same time, there are also many dividend ETFs that just have a really high expense ratio. You need to deduct this high expense ratio from your, from your dividend yield, because these are costs that are deducted from the dividends that are just not yours. And last but not least, some dividend ETFs also have seen strong dividend cuts during the crisis, and I think 2009 and 2020 during the pandemic were a good example of that. So what can we do about this then? How to avoid these pitfalls? First of all, I would say if you at least invest in 1 or 2 or 3 ETFs, dividend ETFs, please spend the time to really read their policy and their fact sheet. Every dividend ETF is obliged to tell you what their investment strategy is. And understanding this and seeing if it aligns with your own goal is really, really important. This takes you maybe 5 minutes of time actually, and you will know already enough. Just 5 minutes. You don't need to spend like 5-6 hours analyzing an individual stock. Just go to the website. I will show you soon what I mean with that, and just look into it for a few minutes. That's it. But also understand the top holdings in the ETFs. Are these companies that you feel comfortable with? Can you understand, for instance, for the first 10 companies in the portfolio, can you see growth in them? Can you see earnings growth, revenue growth? Do they have a healthy balance sheet? It doesn't even need to take too much time. Most people have a feeling for this, so don't worry about that. It's just a quick overview for you that I really recommend you doing. Third one, just have a look at their total return. Check what their dividend yield is minus the expense ratio. Are we talking about 1%, 2%, 3%? And have a look at their 5-year dividend growth. This takes a little bit more of work, but on every website you can find the dividend history from those ETFs. Just look at what they were paying 5 years ago and check if they had stable dividend growth over time or whether it was more volatile. This all matters. Really, I think that doing this really allows you to see in 10 minutes, 15 minutes, maybe half an hour whether this dividend ETF is the right ETF for you. And then at that moment in time, you probably can just put it on autopilot, invest automatically every month, and you don't need to look back. So my recommendation is just spend these few minutes. It makes you so much a better investor and really allows you to avoid some really typical pitfalls that we're looking into. But hey, if you're not sure yet what I mean with that, let's just look at one ETF here. Just one example dividend ETF to avoid. For me, this is the SPDR S&P Euro Dividend Aristocrat ETF. Dividend Aristocrat already, kind of suggests you that we're talking here about growing dividend payers. And at the moment, it pays around 2.7% yield and a total expense ratio of 0.3. So your real actual yield is 2.4. Keep that in mind. Now, what is their dividend policy actually saying? They measure the performance of the 40 highest dividend yielding Eurozone companies. So they are not talking here about dividend growers, they are talking about the highest dividend yielding companies that have been increasing or stable dividends for at least 10 consecutive years. You need to know a dividend aristocrat in the US usually has 25 years of dividend growth. 10 years doesn't even cover the latest great financial crisis. Please keep this in mind because this is so important and you see that here. This dividend ETF has not grown their dividends over the last 7 years. Actually, their latest annualized dividend payment is actually lower than what they were paying in 2014. And look at the companies. Come on, these companies, most of you don't know them because these are companies that don't speak to people's mind. These are not the Apples and Microsoft of this world or the Johnson & Johnsons. These are companies that are actually quite mediocre. I mean, Enagas, it's a nice company, indeed a high yielder, but it's not a company that provides you with dividend growth. And in that case, you may expect a much more higher yield than 2.7 for an ETF like this. So in my opinion, although the name suggests differently, you should really avoid this dividend ETF if you're a dividend growth investor. But that's not it when we talk about pitfalls, because I also would like to show you one example of a dividend ETF or a dividend paying ETF, which is really, really popular at the moment in dividend community. But here I would really say know what you own. And that one is the Global Nasdaq 100 Covered Call ETF. People love it because the yield here is 11% at the moment if you take the expense ratio of it. This is really large. And as you can see here, it has Apple, Microsoft, Amazon, Tesla in here. Not the typical dividend stocks, because what is important here, you need to understand that this is not a dividend ETF. Although many people, newcomers in the dividend investing community still think it's a dividend ETF. Yes, it pays dividends. I would say it might be a dividend ETF to consider for if you want current yield, but it's all based on covered call writing. If you're not familiar with option trading, I would say look a little bit up on Google what a covered call is, but effectively what you're doing here is what this ETF is doing here is they buy, for instance, stocks in the brackets of 100, and once they own them, they start writing calls, which means an obligation to sell the 100 stocks at a certain price based on the covered calls that they have agreed with the one that buys the call. So the buyer has the right to buy those stocks for you, and you, as a covered call seller, get a premium in return. Those premiums collected is what is giving this ETF at the moment a 10 to 11% dividend yield. So, but look at this. Over the years, since 2015, the income was flat. Yeah, and that's okay, I think, because you got a really, really high yield in return. But also look at the price chart. where actually 5 years ago you still paid $25 for this ETF. Now you pay 22.25 for this ETF. So you actually lost money. So what you need to know with this one, it has been also really volatile during the pandemic. What you need to know is that over time, you will see capital depreciation. So if you're already retired, you really need to take into consideration that your capital over time will slightly decline. And if you are lucky, you will continue to benefit from the same dividend income. However, there are no guarantees there. I think also what you will see is that over time, the dividend income will also decrease. We have been in the longest bull market ever. So it is for me really, really a risky trade here. Enjoy it while it lasts, but just know what you own. This is not your typical dividend ETF. And if you're a dividend growth investor, then really understand why you're buying this. Probably to support the reinvestment of dividends in the accumulation phase here, but don't expect capital growth here and dividend growth in this one. So enough about pitfalls and about knowing what you own. Let's look now at the best 3 dividend ETFs that I think exist right now. And the first one is the Vanguard Dividend Appreciation ETF. You can find it by the ticker VIG, and it currently has a dividend yield of 1.62% and an expense ratio of 0.06%. This is a really low dividend yield in my opinion. It effectively gives you a 1.5% dividend yield at this moment in time, which for me, according to my dividend growth strategy, wouldn't be enough. But I would like you to be aware of this dividend growth ETF because look at it here. The annualized dividend has been just growing over the last, let's say 13, 14 years, and over the last 5 years with an average growth of 8%. These are the kinds of dividend ETFs that you should look into. And for instance, should keep an eye on if there is an upcoming market crash. Because if you get this dividend ETF at, for instance, a yield of 3%, damn, go for it. This is what I will do for sure. And you can also see why this dividend ETF is so good, because the top 10 companies are really top notch in this ETF. And these are companies that I would all love to own at the right price. For me, the ETF at the moment is overvalued, but it is one of the strongest dividend appreciation ETFs that I'm aware of. The second one goes by the ticker DGRO, and it's the iShares Core Dividend Growth ETF. Also here again, a nice dividend growth. It currently yields around 2% with an expense ratio of 0.08. Again, a low cost ETF. But what I love about this dividend growth ETF is that it has a annualized dividend growth of 13.5%. You can see that. I think the dividend ETF exists since early 2015, and it has been growing the dividends on an annualized basis over time all the way up till now. Look at these companies here as well, Microsoft in here, but also JP Morgan, Verizon, and that's why also the yield is a little bit higher because it has some high yielders also in the top 10, but at the same time, it has also some companies in here that have been really growing their dividends above average growth rates, in my opinion, 6 to 8%. This one has 13.5%. This is really good, and I will show you later where the difference is. But the ultimate dividend ETF for me to own now, actually, that you could buy today, is the one from Schwab, the US Dividend Equity ETF, which goes by the ticker SCHD. It currently has a yield of 2.93%, almost 3%, and expense ratio of 0.06%. Personally, I'm looking at buying this ETF on a monthly basis for my wife's portfolio. I really, really like this ETF. What do I like about it? I could have written this myself, their dividend policy or their ETF policy, because what they say here is that they invest in companies that have a record of consistently paying dividends selected for fundamental strength relative to their peers based on financial ratios. So it's the same what I'm doing. I'm looking at dividend safety, but also whether a company is undervalued. That's the same setup for this dividend ETF. It also shows you, therefore, that this dividend ETF is a little bit more managed, I think, than the other one from the Vanguard. But at the same time, it still has this low expense ratio. So they're looking for companies that have at least 10 years of consecutive years of dividend payments. And they really evaluate them based on cash flow to total debt, which is really a good metric because it shows you the earnings power, but also the return on equity, Warren Buffett's favorite metric, the dividend yield, and the 5-year dividend growth rate. But at the same time, no stock can represent more than 4% of the index. This is exactly the same as my own dividend allocation strategy, where I also have a boundary of 4% when I'm looking at my retirement goal of the 40 stocks that I want in my portfolio. And also the same here, they don't want to be overweight into a certain sector, and they have a limit there for 25%. So having said that, I think this ETF is the one that most closest mimics my own dividend growth investment strategy. And this one I feel personally really well with to sleep well at night. And just look at it. The performance has also been really great. They have been growing their dividends all the way from 2012 when it got initiated to 2021 right now at a 5-year dividend growth of almost 15%. So even more than the iShares dividend growth ETF. It just shows me the power of the underlying policy of this dividend equity ETF. So you get it for almost 3% with a 15% almost 5-year annualized dividend growth, which is of course really huge. We need to also understand that we are at top earnings, top dividend growth for companies. But what you can see here already is there's no Microsoft in it and no Apple in the top 10. And that's probably the main difference between the other ETFs, because those are low yielders. And that's why I believe this dividend equity ETF is a higher yield than the other two. And I'll show you that here. Look at the top holdings here and look at what's on number 1 and number 2 and number 3. At the same time, this ETF is also more concentrated with around 40% of the top 10 consisting of these companies. The other top 10 is around 25% and 31%. So it also tells you that this ETF is more concentrated. It might mean that going forward, maybe the VIG from Vanguard might have a better performance from where it is today. But you know, the yield on the one from Schwab's is twice as high. So it needs to really outperform a lot, this one, to get to a certain yield of cost after 10 years as the same you would get with the one from Schwab's. So that this ETF from Schwab's performed so well should come as no surprise. But just look at some of these companies here. So in this case, Texas Instruments, it has a dividend growth of 15 years and a 5-year annual growth rate of 21%. Higher than the 15%, so it really keeps the average high. But the same for Home Depot, which was in the top 10, 19% dividend growth rate. And then the last one, Broadcom, 49% dividend growth rate. I don't know if the companies currently in the top 10 will be able to do this going forward. But remember, this dividend ETF is also mixing things. Yes, so it's not purely keeping all the stocks until eternity. It is actively making some changes to the dividend ETF based on their valuations and the criteria that they have outlined in their policy. So having said that, I'm very, very much happy with this ETF, the Schwab ETF, and I consider starting to initiate positions in it for my wife's portfolio and start accumulating them over the upcoming few months. So this is it from my side. I've showed you the pitfalls of investing in dividend ETFs, but also how you can avoid them. I've shown you some examples, and I've showed you just the 3 best dividend ETFs that are out there, in my opinion. If you want to learn more about dividend ETFs, then also make a visit to my website. If you go here to the homepage and you go to dividend investing, all about dividend ETFs, you will see here much more details about dividend ETF investing by itself, including a frequently asked questions overview. Have a look at it if you want to learn more. I will put the link into the description of this video. Having said that, if you enjoyed this video, don't forget to subscribe, like this video, and share it with your friends and colleagues. I'm trying to make dividend growth investing easier for all of us, and I'm more than happy to share my knowledge with you. So, hey, have a great weekend. See you again.